It's Labor Day weekend, and I guess that means that summer is officially over, and it certainly means that August is over. And so take a little look back. August was a positive month in the markets. In fact, it was the 7th in a row, which, is a long streak by historical standards.
Right. It's the longest streak we've seen since January of 2018. The S&P for the year now up 20.4%. It's sixth best performance on an annualized basis since 1950. So very strong equity performance. And it really should come as no surprise because corporate earnings continue to surprise on the upside and interest rates continue to remain very low.
I think that's a great point to make because a lot of people have been asking, why is this market up so much? What's going on? Is this built on a house of cards? So you can take some of those pieces and talk about the growth in corporate profits. In fact, we are substantially higher right now in corporate profits than we were pre-pandemic period.
Right. We've exceeded the prior peak in corporate profits, GDP. The only area that we haven't exceeded the prior peak is in labor, in terms of unemployment rates, which were very low, 50-year lows at 3.5%. The most recent report, which we got on Friday, had the unemployment rate go from 5.4 to 5.2. So it naturally begets the question, what is the idea of full employment to the Fed? Is it 3.5% or is it somewhere between where we are currently and 3.5%? Because the economy has certainly changed since the pandemic.
And some of the data that we just saw basically shows us that jobs growth is really dramatically slowing down. We had a couple of data points on that recently, and that instantly turned the narrative to stagflation, stagnating economic growth, but inflationary pressures.
Right. We've had the short-term bottlenecks that have caused spikes in the price of, say, lumber and copper, and we see semiconductor shortages, which has affected the availability of automobiles, for example. So that's putting a little bit of a negative spin on supply while the demand remains. We have households with record levels of net worth. Corporations are flush with cash. We see lots of stock buybacks occurring. So the environment is a little skewed in terms of what we normally would see. So as an investor, what we've been trying to figure out is how sustainable is the current growth of the economy. We saw that the Atlanta Fed, for example, a couple of weeks ago was thinking GDP in Q3 would be up about 7%, and they're now down to 5% because we have seen some disappointing retail sales numbers. In the labor report, we saw that hospitality services, no growth there at all. Again, the Delta variant affecting people's willingness to go back to work, go out, and spend money.
So, yeah, right, causing that stagnation in growth like we just talked about. And then one of the reasons, I always think about this in terms of why. Like, what does this mean? Why are we paying attention to this? And one of the big reasons is to get a sense of where we might be headed with monetary policy, because monetary policy is a strong driver in terms of where we're headed from an economic growth and therefore stock market.
The chairman of the Fed has repeatedly said he's focused on two things: price stability, and he said he'd allow that to run hot above their 2% target for a time because we've been below that level for so long. But the key focus of the Fed seems to me to be wage growth and unemployment, reducing unemployment to pre-pandemic levels. And that requires a response from the Fed. Right now, that job is not done. That most recent labor report said that basically we have not seen the substantial further progress in the labor market that they want to achieve. So the expectations now are that we won't see tapering in 2021.
So you get high liquidity for a longer period of time, you get persistently low interest rates, and you've got corporate growth. And so therefore, you've got an expanding stock market.
And you've got very little competition from some elements of fixed income, CDs yielding under 1%. I mean, why would you buy a CD yielding under 1% when you can buy an energy company yielding 6% in an improving global economy?